There's a metal conducts electricity better than copper, fights bacteria naturally, and costs 1% of what gold does. Yet, most investors ignore it. While tech companies quietly stockpile it for AI servers and solar manufacturers scramble for supply, the financial media treats it like yesterday's news. Here's what happens when a material becomes essential to the future while everyone's looking the other way. Something unusual is happening in commodity markets. Silver is caught between two forces that rarely pull in the same direction simultaneously: technology that can't function without it, and economic uncertainty that makes tangible assets attractive. This isn't speculation, this is observable fact. And by the end of this video, you'll understand why silver's position in 2026 is fundamentally different than any other commodity you're watching. No hype, no unverified claims, just the structural reality that most analysis completely misses. Let's start with what makes silver unlike anything else in your portfolio option. Silver is the only major commodity that serves two completely different masters at the same time, and both are demanding more of it right now. Every solar panel installed globally requires silver paste to convert sunlight into electricity. There is currently no cost-effective replacement that matches silver's conductivity and reliability at scale. Every 5G cell tower uses silver in its electronic components because signal integrity at high frequencies demands it. Every electric vehicle charging station relies on silver contacts because failure in high current applications is catastrophically expensive. Data centers powering AI models use silver in server components because computational reliability is non-negotiable when you're running million-dollar training runs. Medical facilities use silver's antimicrobial properties in wound dressings and catheters because infection control saves lives. This is an optional demand. This is structural demand built into the architecture of modern infrastructure. Simultaneously, silver serves as accessible wealth preservation. While gold requires significant capital per ounce, silver provides the same inflation hedge characteristics at entry points available to far more people. When real interest rates turn negative, when inflation exceeds what your savings account pays, tangible assets historically outperform cash. Silver offers that tangible alternative without requiring thousands of dollars per unit. Here's why this dual nature matters. Most commodities face demand destruction during economic weakness. Silver faces a paradox. If the economy strengthens, industrial demand accelerates. If the economy weakens and uncertainty rises, monetary demand accelerates. The metal doesn't need to pick a side. It benefits from both scenarios. Here's the part that changes everything about how you should think about silver availability. Approximately 70% of silver mined globally comes out of the ground as a byproduct of mining other metals. When companies dig for zinc, lead, copper, or gold, silver comes along for the ride. This creates a supply dynamic that most investors fundamentally misunderstand. When silver prices rise, you cannot simply increase silver production. You're tied to the economics of the primary metal being mined. If zinc demand is soft, that silver-producing zinc mine doesn't expand just because silver prices doubled. The business case runs on zinc, not silver. This means silver supply is structurally inelastic in ways that pure primary production metals are not. Even for primary silver mines, the supply response to higher prices is measured in years, not months. A new mine requires 2 to 3 years for exploration and feasibility studies, 1 to 2 years for permitting and environmental approvals, 3 to 5 years for construction and ramp up to full production. You're looking at a 5 to 10-year lag between silver prices are high and new silver supply hits the market. Meanwhile, industrial demand doesn't wait. Solar installations happen this quarter. Data centers get built this year. Grid upgrades proceed on scheduled timelines. Unlike gold, which mostly sits in vaults and can theoretically return to the market, much of the silver used industrially is consumed and dispersed. A circuit board might contain 0.3 grams of silver. When that device ends up in a landfill or gets partially recycled, that tiny amount of silver is economically unrecoverable. It's functionally lost to the supply pool. Multiply that by billions of devices, and you begin to understand why available supply is not the same as total above-ground supply. The silver exists, you just can't access it profitably. Let's get specific about what's creating industrial silver demand right now. The International Energy Agency's 2025 report projects solar capacity additions will continue accelerating through 2030. Each panel requires approximately 20 grams of silver in paste form for the photovoltaic cells. Yes, manufacturers have reduced silver content per panel by roughly 30% over the past decade through thrifting technology. But global solar installations have more than tripled in that same period. Total silver consumption for solar has increased even as per unit usage decreased. That's the math that matters. In 2026, with energy security and climate commitments driving policy globally, solar installation pace is not slowing down. The computational build-out for AI is creating unprecedented demand for reliable electronics at scale. Each GPU server cluster requires thousands of connection points, each needing materials that won't fail under thermal cycling and electrical stress. Silver's thermal and electrical conductivity make it the preferred choice for critical connections. Microsoft, Google, Amazon, and Meta are collectively investing over $200 billion in data center infrastructure in 2026 alone. That's not speculation. These are announced capital expenditure plans. Every rack of servers, every networking switch, every power distribution unit contains silver in amounts that individually seem small, but collectively create millions of ounces of demand. It's not just the vehicles, it's the entire charging infrastructure being built globally. High current DC fast chargers use silver in contactors and relays because electrical arcing and contact degradation are failure modes that strand customers and damage brand reputation. Grid upgrades to support EV charging use silver in switchgear and control systems. Vehicle to grid V2G technology, being piloted in 2026, requires even more sophisticated power electronics with enhanced reliability requirements. Higher frequency electromagnetic waves require better conductivity materials. Silver's superior conductivity compared to copper becomes more valuable as frequencies increase. With 6G research moving toward millimeter wave bands, the requirement for superior conductive materials intensifies, not diminishes. Silver's antimicrobial properties are increasingly valuable as antibiotic resistance becomes a more serious healthcare challenge. Silver embedded wound dressings, catheter coatings, and surgical instrument applications are expanding, not contracting. Understanding how silver trades requires understanding this fundamental split. COMEX futures contracts allow massive position taking with leverage. A single contract controls 5,000 ounces of silver, but requires only a fraction of that value in margin. This creates price discovery efficiency, but also enables rapid price movements disconnected from physical availability. ETFs like SLV and PSLV allow investors to gain silver exposure without taking physical delivery. Holdings are measured in hundreds of millions of ounces, creating genuine demand for physical metal, but with different liquidity characteristics than industrial consumption. When you buy physical silver from a dealer, you pay a premium over spot price. This premium reflects fabrication costs, distribution and handling, dealer margins, supply-demand balance in the physical market. When premiums rise, it signals that physical availability is tightening relative to demand, even if the spot price hasn't moved proportionally. In January 2026, premiums on American silver eagles and other popular coins remain elevated compared to historical averages. This indicates sustained retail demand for physical metal. Theoretically, when physical premiums get too high, arbitrage should bring them down. Someone buys COMEX futures, takes delivery, and sells the physical at the higher retail premium. In practice, this arbitrage has frictions: vault fees, transportation, fabrication into retail forms, dealer relationships, and timing lags. When physical demand is persistent and broad-based, premiums can stay elevated for extended periods because the arbitrage can't scale fast enough. Stop watching just the price chart. Start watching these structural indicators that actually predict directional changes. 1. Real interest rates. This is inflation minus bond yields. When this number is negative, holding cash loses purchasing power. This historically drives allocation toward tangible assets. The US 10-year Treasury yield versus CPI gives you the real rate for dollar-based investors. Watch this monthly. When real rates turn more negative, precious metals historically strengthen. When real rates turn positive, pressure increases on non-yielding assets. Dollar strength index. Commodities are priced in dollars globally. When the dollar strengthens against other major currencies, it typically creates headwinds for commodity prices. But watch for disconnects. If silver holds up or rises while the dollar strengthens, that signals unusually strong underlying demand, overwhelming the currency effect. Copper is the bellwether for industrial metals and electrification. Strong copper prices signal healthy industrial activity, which typically means strong industrial silver demand. If copper weakens while silver holds, that's unusual and worth investigating. It might signal monetary demand is dominating the silver price action. The amount of silver in COMEX-approved warehouses is publicly reported. Declining inventories indicate more metal leaving than arriving, suggesting tightness. Rising inventories suggest adequate supply relative to immediate demand. Check this monthly at the CME Group website. It's public data. ETF holdings. Major silver ETFs report their holdings daily. SLV, iShares Silver Trust, is the largest. PSLV, Sprott Physical Silver Trust, is another major holder. Rising holdings show investment demand increasing. Declining holdings show net redemptions, investors exiting positions. Physical premiums. Check dealer websites weekly. Compare the premium percentage over spot price for standard products like American Silver Eagles or Canadian Maple Leafs. Premiums above 20% historically indicate very strong physical demand. Premiums below 10% indicate comfortable supply. 7. Manufacturing PMI. The Purchasing Managers Index for manufacturing tells you if industrial activity is expanding above 50 or contracting below 50. Strong manufacturing activity typically supports industrial metal demand. Weakening PMI warns of demand destruction risk. Let's be completely honest about what could hurt silver prices, because risk management is more important than upside fantasy. A severe economic contraction would significantly reduce industrial demand. While monetary demand might increase, the industrial component of silver makes it more vulnerable than pure monetary metals like gold during demand destruction. If global manufacturing slows dramatically, silver prices face serious headwinds regardless of monetary factors. Substitution risk. Industries are constantly working to reduce input costs. If silver prices rise significantly, R&D budgets get directed toward finding alternatives or reducing silver content further. This has already happened in photography. Film to digital eliminated massive silver demand and continues happening in electronics. However, substitution is not instant and often involves performance trade-offs. Critical applications will pay up rather than compromise on reliability. Liquidity events. During financial panics, correlations go to 1. Almost everything sells as investors raise cash, meet margin calls, and flee to government bonds. Silver's smaller market size and higher volatility mean it typically sells harder than gold during these events. This doesn't invalidate the long-term thesis, but it means you cannot assume silver will protect you during acute financial stress. Sometimes it sells first. This combination is kryptonite for precious metals. If real yields turn significantly positive while the dollar strengthens, silver faces powerful headwinds from both directions. This scenario would require inflation falling faster than nominal rates, while the dollar gains against major currencies. Possible, but would require significant policy shifts. Here's how to think about silver allocation in practical terms. Are you holding for industrial demand growth over 3 to 5 years, monetary hedge against currency debasement, portfolio diversification independent of outcome, speculative trade on near-term catalysts? Your thesis determines your timeline, position size, and exit criteria. Be honest about which one describes you. Pros: you own it outright, no counterparty risk, survive systemic events. Cons: premiums eat into returns, storage security required, less liquid than paper. Best for long-term holders, monetary thesis believers, people wanting tangible assets. Pros: highly liquid, no storage hassles, easy to trade. Cons: management fees, counterparty risk, no physical possession. Best for investors wanting price exposure without physical logistics. Pros: leverage to silver price. Mines can profit more as prices rise. Dividend potential. Cons: company specific risks, management quality varies, correlation isn't perfect. Best for investors comfortable with equity risk and company analysis. Pros: high leverage, sophisticated strategies possible. Cons: complex, time decay on options, margin calls, can lose more than invested. Best for experienced traders only with active risk management. Most financial advisors suggest precious metals represent 5 to 10% of a portfolio if included at all. This is conservative guidance based on volatility and opportunity cost. Your personal situation might justify more or less, but understand the trade-off. Over-concentration in any single asset class increases risk. Silver is more volatile than gold. Expect price swings of 5 to 10% in a single day during volatile periods. If you cannot emotionally handle watching your position drop 20% in a week, your position is too large. Buying a full position at once exposes you to timing risk. You might buy at a local peak and watch it decline for months. Dollar cost averaging, buying equal amounts at regular intervals regardless of price, smooths out volatility and removes emotion from entry timing. Example: instead of buying $10,000 of silver today, buy $1,000 per month for 10 months. You'll average out the price swings. Hope is not a strategy. Determine in advance. At what price or percentage gain do you take partial profits? What events would invalidate your thesis? What maximum loss percentage triggers exit? Write these down before you invest. Emotion during volatility will cloud judgment. Pre-commitment to rules protects against emotional decisions. Tax considerations. Physical precious metals are taxed as collectibles in the US, with a maximum 28% long-term capital gains rate, higher than the 15 to 20% rate for most securities. ETFs may be structured differently. Mining stocks follow standard equity tax treatment. Consult a tax professional about your specific situation before making allocation decisions. Let's bring this into the current moment with what we're actually seeing right now. Central banks globally are navigating the tension between inflation concerns and growth weakness. Interest rate policy remains uncertain, creating volatility in currency and bond markets. This uncertainty typically benefits assets that don't depend on any single policy outcome. Silver's dual demand profile positions it to benefit from either economic strength, industrial demand, or uncertainty, monetary demand. The post-pandemic supply chain restructuring continues. Companies are prioritizing resilience over pure cost optimization, which means redundant supply chains and strategic stockpiling of critical materials. Silver qualifies as critical for electronics and energy infrastructure. This strategic stockpiling represents demand that doesn't show up in traditional consumption statistics until the material is actually used. Regardless of political shifts, the capital already committed to energy transition infrastructure is being deployed in 2026. Solar installations, grid upgrades, and electrification projects have multi-year timelines and continue regardless of headline noise. This creates a demand floor for industrial silver that is relatively insulated from quarterly sentiment swings. Trade tensions, regional conflicts, and resource nationalism create supply uncertainty for commodities. Silver mining occurs globally, but concentration in specific regions creates potential disruption risk. Peru, Mexico, and China are major silver producers. Policy changes or operational disruptions in any of these regions can affect global supply. January 2026 has seen mixed signals in investment demand. ETF holdings show modest fluctuation, indicating neither strong accumulation nor mass liquidation. Physical premiums remain elevated, indicating steady retail demand continues but hasn't accelerated into panic buying. This suggests we're in a wait and see phase for investment demand, with the potential to accelerate in either direction depending on macro catalysts. Here's what to do with this information, stated clearly and without ambiguity. If you're new to silver, 1. Spend at least 2 weeks researching before allocating any capital. 2. Start with a small position, 1 to 2% of portfolio, to observe how you react to price volatility. 3. Choose the exposure method that matches your technical comfort level and timeline. 4. Set clear rules for adding to or exiting the position. If you currently hold silver, 1. Review whether your original thesis still holds given current conditions. 2. Verify your position size still aligns with your risk tolerance. 3. Consider whether rebalancing makes sense if silver has become overweight. 4. Update your exit criteria based on current market structure. If you're skeptical, 1. That's completely valid. Skepticism protects against emotional investing. 2. Identify what specific conditions would change your view. 3. Monitor those conditions to remain open-minded. 4. Understand the bull case well enough to recognize if conditions shift. For everyone, bookmark the data sources mentioned: CME warehouse stocks, ETF holdings, PMI data. Check them monthly, not daily, to avoid noise-driven decisions. Focus on trend changes over multiple months, not single data points. Never invest based solely on one analysis. Seek multiple perspectives. Silver in 2026 sits at an unusual intersection. Technology can't advance without it. Economic uncertainty makes tangible assets attractive. Supply is structurally constrained. Demand has two independent engines pulling in the same direction. Whether that translates to higher prices depends on variables no one can predict with certainty. What you can control is your understanding of the market structure, your position sizing, your risk management, and your emotional discipline. This analysis gave you the framework. Your financial situation, risk tolerance, and goals determine what you do with it. The silver market will continue evolving. Stay informed, stay skeptical of certainty, and make decisions that align with your actual circumstances, not someone else's conviction. This is educational analysis, not financial advice. Do your own research. Consult professionals who know your complete financial picture. Make decisions you can live with, regardless of outcome.